Hello and welcome back to Vitsec here, where we bring you the insights into the world of finance. In today's video, we're going to delve into one of the most notorious financial scandals in history, the Libor and Euribor scandal. We'll explore what it was, the global impact it had, the regulations implemented as a result, its impact on India, and lessons learned from this scandal. So let's jump right in. First things first, let's start by understanding what interbank lending is. Essentially, interbank lending refers to the borrowing and lending of funds between banks themselves. Banks lend to each other for various reasons, such as when one bank has excess funds and the other needs liquidity to meet its obligations. Interbank lending plays a crucial role in maintaining the stability and functioning of the financial system. Now let's move on to Libor and Euribor. Libor is the London interbank offered rate, which is the benchmark interest rate that is used to set interest rates on a wide range of financial products such as loans, mortgages, and derivatives. It is calculated by a panel of banks who submit their estimates of the interest rate at which they would be willing to lend to each other. Euribor is the Euro interbank offered rate, which is the equivalent of Libor for the Eurozone. It is calculated in the same way as Libor, but using a panel of Eurozone banks. The Libor and Euribor scandals that started in the early 2000s were both major financial scandals that involved the manipulation of interest rate benchmarks.
Under investigation is the allegation that Libor and other key benchmark lending rates may have been manipulated by certain bank employees during the financial crisis.
In both scandals, traders at several banks were accused of submitting false or misleading rates to benefit themselves or their clients. For example, a bank that wanted to make its profits look better might have submitted a lower rate than it was willing to lend at. Or a bank that wanted to benefit a client must have submitted a higher rate than it was willing to lend at. Libor and Euribor scandals were uncovered in 2012 and 2013 respectively. The scandals led to several investigations and reforms.
Developments in the interest rate manipulation scandal. The Wall Street Journal reports the European Union is set to accuse several banks of attempting to rig the setting of the Euribor lending rate. Barclays has already admitted that.
The UK Financial Conduct Authority, or FCA, fined Barclays Bank £290 million for its role in the Libor scandal. The US Department of Justice, or DOJ, fined Barclays Bank and UBS £290 million and £1.5 billion respectively. Regulators around the world fined the banks involved in the Euribor scandal a total of €9 billion. The Libor and Euribor scandals led to many steps being taken to improve the transparency and integrity of interest rate benchmarks. These steps include, number one, the introduction of new regulations. The Benchmarks Regulation, or BMR, was introduced, and the European Market Infrastructure Regulation, or EMIR, was also amended in response to the scandals. These regulations set out requirements for governance, calculation, and publication of interest rate benchmarks. Number two, the establishment of independent benchmark administrators. The ICE Benchmark Administration, or IBA, and the European Money Markets Institute, or EMMI, are two independent benchmark administrators that were established in response to the scandals. These organizations are responsible for calculating and publishing Libor and Euribor respectively. Number 3, the increased use of alternative benchmarks. The scandals led to the increased use of alternative benchmarks such as the Secured Overnight Financing Rate or SOFR and the Euro Overnight Index Average or EONIA. These benchmarks are less susceptible to manipulation than Libor and Euribor. Number 4, the improvement of market surveillance. Market surveillance is the process of monitoring the markets for signs of manipulation. The scandals led to an improvement in market surveillance as regulators and market participants became more vigilant in detecting and preventing manipulation. These steps have helped to make interest rate benchmarks more transparent and less susceptible to manipulation. However, it is important to note that no benchmark is immune to manipulation. Regulators and market participants need to remain vigilant to protect the integrity of interest rate benchmarks. The Reserve Bank of India or RBI also took several steps in India after the Libor and Euribor scandals. These include, number 1, issuing guidelines on the governance of benchmark interest rates. The RBI issued guidelines on governance of benchmark interest rates in 2014. These guidelines set out principles for the independence and transparency of benchmark administrators. The guidelines require benchmark administrators to be independent of market participants and to have adequate governance arrangements in place. Number 2, introducing the Indian Overnight Indexed Swap or IOIS as an alternative to Libor. The IOIS was introduced in 2013 as an alternative to Libor. The IOIS is based on actual transactions in the Indian overnight money market. It is calculated using a methodology that is designed to be more transparent and less susceptible to manipulation than Libor. Number 3, establishing the Financial Benchmarks India Limited or FBIL as an independent benchmark administrator. The FBIL was established in 2017 as an independent benchmark administrator. It is responsible for calculating and publishing the IOIS as well as other benchmark interest rates in India. The FBIL is a non-profit organization that is governed by a board of directors. Number 4, improving market surveillance. The RBI has also improved market surveillance in India. This includes monitoring the markets for signs of manipulation and taking action against those who engage in illegal activity. The RBI has increased its focus on monitoring interest rate benchmarks, and it has also worked with market participants to develop new procedures to prevent manipulation. Now let's discuss the lessons we learned from these scandals. Firstly, these incidents underscored the need for robust regulatory oversight and governance in financial markets. Stricter regulations were implemented to prevent price manipulation, improve transparency, and foster a level playing field for all participants. Secondly, the importance of active surveillance and monitoring mechanisms was highlighted. Regular checks and audits should be in place to detect any potential abnormalities in benchmark rate submissions, ensuring the accuracy and integrity of these rates. Thirdly, there was a shift towards more diverse and data-driven benchmark rates. Relying on a single rate, such as Libor, proved vulnerable to manipulation. By implementing alternative benchmark rates based on observable transactions, the risk of manipulation can be significantly reduced. Lastly, these scandals emphasize the significance of ethical conduct, trust, and integrity within the financial industry. Market participants should prioritize ethical behavior, adhere to regulations, and maintain the highest standards of professionalism. And that's a wrap on our discussion about the Libor and Euribor scandals. We explored what these scandals entailed, the actions taken to address them, and the valuable lessons we learned along the way. Remember, awareness and understanding of such scandals are crucial to safeguarding the integrity of our global financial system. If you found this video helpful, please give it a thumbs up and share it with others who might benefit. And don't forget to subscribe to our channel for more informative videos. Thank you for watching, and as always, stay curious and keep exploring the world of finance.